Hello everyone, welcome back to my channel for another video. Today I'll start by providing a tutorial on how to analyze price action and determine high probability entry points using, obviously among other things, the path of least resistance. The path of least resistance, as you already know, is a practical trading approach that allows traders to determine the most favorable direction to trade by essentially examining the left side of the chart. Additionally, I'll discuss some key technical factors such as stop hunts, which help us establish trading ranges. I'll also talk about trends, market bias or market direction, it's the same concept, and the influence of various patterns to help you improve your analysis process. My goal with this video is to help you have a better understanding of how to spot those high probability entry opportunities. However, it's important to note here that high probability in day trading doesn't mean perfection or infallibility, but it is the key, in my view, to consistent profitability. So if you are interested in learning how to interpret the data represented in the charts, then make sure to watch this video in its entirety. Alright, so on the 3-minute time frame, we can observe a sudden wave of selling that has caused the Euro-USD pair to sharply drop in value. Such a nosedive or rapid repricing indicates to me that it's best at this point to let the market settle and move in its directional or preferred bias before we can start assessing new levels. This will help, I think, us identify important structural market areas that may precede a more significant price movement. And as you can see in the chart, after this reversion above the 1200 level, which marks a new structural low for the session, the forex pair moves impulsively upwards. The market then retraces for a brief period before continuing to rise again and again. Now, in the dynamic world of trading, where buyers and sellers constantly fight for new positions, we see an interesting development that I think sheds light on the intricacies of price action. If you noticed, the supply side within this trading range clearly finds itself incapable of challenging the newly established structural lows of the session as the market keeps printing higher lows. This development serves, in my view, as a strong confirmation when it comes to the formation of this algo-driven stop hunt zone, which, as you already know, refers to a trading strategy where smart money intentionally manipulated the price of an asset to trigger the stop-loss orders of other traders. This tactic is often employed by Wall Street stock firms to flush out weaker players, obviously from the market, and take advantage of their positions. Also, keep in mind here, guys, that stop hunting is a price action movement often seen near downtrend lows. So in essence, what we have here is a temporary bottom being firmly established in the market's current landscape. Obviously, the significance of this occurrence cannot be overstated, since it not only offers solid information into the psychology of market players, but also offers us valuable insights into the market's direction or bias, which is a crucial trading factor to consider before entering trades. And as I mentioned at the beginning of this video, while it would be wrong to equate high probability with perfection or infallibility, the formation of a stop hunt in a carefully analyzed price action movement such as this one is definitely, in my view, a key element to consider if you want to achieve profitability. Okay, so from our liquidity grab zone down here, we see the market imposing to the upside, a brief retracement and period of accumulation ensues as the market reaches an initial high at the 1264 level. The market then embarks on a downward trajectory, seeking support at the 1240 area. This support level clearly, as you can see the chart, acted as a temporary floor, preventing further decline, and created at the same time an opportunity for the demand side to step in and drive prices to new session highs. Now the jump to a new intraday high here above the 1275 level and the formation of another stop hunt zone that obviously marks the top of this entire trading range. So the formation of this liquidity grab area or stop hunt area is the same concept, sets in my view a new bias and trend direction for the market. And this is because we know that the direction and then the formation of this price movement up here is consistent with the pattern of an algo-driven stop hunt expedition, which, as you already know, tend to occur near uptrend highs. So it goes without saying that the dynamics within this liquidity grabbing area can be quite significant for traders. I think that understanding the intentions and actions of smart money can certainly provide insights into potential market manipulation and help traders navigate through volatile periods more effectively. So as the market experiences another nosedive, it results in a break in market structure, and obviously the formation of this important element here reinforces the new price trend and again market bias. That said, however, the following break in market formation or market structure, so this break in market formation allows us to better analyze price action through the simple concept of the path of least resistance. What that means is that by examining the left side of the chart while observing a price movement on the right side of the chart, we have an added indicator, if you will, to confirm the market's short bias. And this is because in this portion of trading there is a clear trend towards a bearish bias on the right side of the chart versus the left side of the chart, as there have been multiple, as you can see, multiple failed attempts to reach the initial high at the 1264 level, let alone the session highs. Now I want to point out here that despite these bearish tendencies on the time frame, this whole price action does not confirm to us an entry point. This simply means that we are going to be more aggressive now if we establish a point of interest. And speaking of point of interest, I think that this next trading area down here seems quite interesting. And again, just by looking left as we draw a descending trend line, so just by looking left of our time frame, we can easily identify the market's persisting bearish tendencies. And guys, if you notice, all I'm doing at this point is reading the data that is being reflected in the charts. Nothing more, nothing less. So there is no complexity here, just identification of simple technical patterns. And speaking again of technical patterns, here we have in plain view the formation of a double top, which, as you already know, serves as a potential reversal signal indicating a shift in market sentiment and a possible opportunity to enter a short position. Now, as I've mentioned previously, nothing is guaranteed when it comes to trading patterns or indicators, since the outcome of any trade is eventually influenced by numerous unpredictable factors. But if we are going to assume there is a pattern or a model to these technical tools, and we are going to be using the market's current bias, I think this entry point over here with a stop loss at the 1246 level is one that's worth considering. Obviously, our profit target should be right around this area. Now, the main point of this tutorial, guys, is to emphasize that trading comes with both risk and opportunity. However, by staying informed about trading patterns, such as stop hunt strategies and their impact, and adapting to changing market conditions and sentiment, as well as understanding market trends, you can effectively, I think, navigate its complexities and improve your chances of making profitable trades. And by the way, if you want more about price action trading, please check out this video up here.